space. So today we are going to start the chapter 1, and we are going to talk about the introduction to business combination and also the conceptual framework, the changes that have been made into the system, into the accounting framework. There's a lot of changes that have been made. We are going to look at some of the changes that have been made to the framework, and also the importance of the word business combination. So we are going to look at the business combination and the reason why business normally want to combine their businesses all together, and also look at the standard for the business combination, what they have to use. There's a standard that they have to follow in the recording of the business combination. We're also going to look at the various type of the business combination. We have the horizontal, vertical, and etc. We are going to look at the type that we have. So we are going to look at first, what is the business combination? Operation of two or more business are brought together under the common control is known as the business combination, whereby two companies are brought together to present one financial statement is known as the business combination. One of the things about a business combination that it can be friendly combination. It can also be some unfriendly. Some people call it hostile or takeover, meaning that friendly simply means that is whereby both companies, board of directors of the companies agree that, okay, we agree that you can combine our business together. So it's the agreement come from the top. It comes from the top. The top agree that we can go ahead and combine the businesses all together. While the unfriendly or hostile takeover is the management oppose one entity or one of the company management oppose the idea of combining the business all together. So it happens, but it's not common. It's not common. Normally, it's not common. Normally, all the business combinations are friendly combination where both of them will agree. Now, the hostile takeover or the unfriendly takeover happen in two ways. One way is when the board of directors decided that, you know what, we are not in support of this agreement or combining this business together. What normally the parent company or the company who want to buy the company or combine do is that they go to the shareholders. They go to the shareholders and offer them more money. So for example, maybe Apple want to buy Yahoo. Yahoo will say, you know what, we are not ready to bought out. We don't want to do the business with you, or we don't want to combine the business together. One of the things Apple can do is that they can bypass the board of directors of the Yahoo and go directly to the shareholders, those who are holding the shares. So let's assume that maybe the Yahoo share is maybe $3. They will say, you know what, we are going to give you maybe $15 per share or $30 per share so that you can join us. So that's what we are hostile takeover. They go and influence. So we call that one tender offer. That's how we call it, tender offer. By going directly to the shareholders and asking the shareholders that, hey, we want to give you more money on your shares because the board of directors are refusing to sell the company or maybe allow us to own the company. So they will give a tender offer to deal directly with the individual shareholders. And when the shareholders agreed, then they can now take over the company. Any questions so far? Any questions so far? No? Okay. Now let's move on. Now, the business combination can be horizontal combination. It can be vertical combination. It can be conglomeration, or conglomeration simply means that it's unrelated businesses coming together. For example, Apple buying maybe Yahoo is related, but it's not too much. So the good example of the horizontal here is, for example, if TNT right? And maybe T-Mobile combined together is horizontal because both of them are in the same business. Verizon and the AT&T are in the same. I remember years ago they tried to combine the business together, but the government stopped them. It stopped them that because of monopoly. They said, no, you cannot do that because if you do that, the only competitors are going to be the T-Mobile. Meanwhile, T-Mobile are the third in online. So if you guys combine together, the cost of those this thing is going to be expensive. So government stopped them of what combining the business work together. There are so many reasons why business normally combine together. One of the reasons is because of the vertical integration of one firm output and another firm distribution or further processing. Maybe because in the market, right, the other company can go, but not all the way in terms of the production. So it's like they can partner with the other companies in terms of distribution or further processing of the goods or the product. That's one of the reason. Another reason was for the cost saving. Cost saving through elimination of duplicate facilities and also staff. The company want to save some money. The company is going down. You're already you are about to declare the bankruptcy. So the other company can come in, and because of the cost savings, you can combine the two business or together. Other reasons are quick entry for the product into the market. Sometimes the company need their product to go to the market. They already know a famous or one of the company who has captured about 95% of the market already. Now they want to be able to enter into the market. The only way they can enter into the market is to partner with somebody, to partner with the company who has already have the large market shares. So he can just partner with them, and then he'll be able to enter into the market quickly. And a lot of companies do that. A lot of companies do this business combination. Some of them too, because the economy of the scale allowing greater efficiency and negotiation power can also be one of the reasons why they allow the business combination to also move forward. Another reason is the avoidance of takeover, right? They don't want the company to go to the shareholders and take over the company. They want to avoid that. So they can willingly go in and say, you know what, we are ready. We can do the business combination. We can combine our business together to avoid any takeover. Some of them too is because of the tax purpose, tax reason. They want to reduce the taxes. They don't want to pay so many taxes. And others is also they have their own personal reasons that they do the business combination. Now, there's a rule that they have to follow in terms of the business combination, identify the accounting standard for business combination. Now, the financial standard, accounting standard board statement where they changed the rule of 141R of the business combination, and also FASB number 160 created something known as the non-controlling interest in the consolidated financial statement. Let's stop here. Now, before we have something called a non-controlling interest. Non-controlling interests are if the company buy less than 100% of the company, it means that there's a non-controlling interest. For example, let's assume that we have A here. A purchase maybe B company. You're going to hear the word parent. A is known as the parent company. Parent company here. B is known as the subsidiary company. Subsidiary company is known as the subsidiary company. If A buy 90% shares or stocks of the B, the 10% here is what is known as the non-control. It means that the 10% is controlled by outsiders. It's not controlled by the A. It's not controlled by the A. Before, this was not, there was different name given to this one here. It's called minority interest. It's called minority interest here. But when the 160 rule was changed from the FA, they changed the name to what? To non-controlling interest. The name changed to the non-controlling interest, meaning that the percentage of the company that belongs to outsiders. Should I come back or it's okay? In my class, they will tell you, I always want to explain it to the bottom for you to understand it. So should I come back or should I move forward?
Move forward.
Move forward. Okay, thank you. So that's where it's so always you're going to hear this word subsidiary company, parent company, non-controlling interest. You're going to hear this word throughout the word, our discussion in this class. The parent company, if they have less than 100%, it means that non-controlling interest exists in the word in the company. Now, this effect took place on the what 2008 when all these changes would occur. Now, how do you identify the various type of business combination method here? There are so many ways, and this is very important. One is that what is acquired. If A, let me go back again. If A here is buying B, if A is buying B here, acquiring B here. The question there, are they buying the net asset of S company? Let's make it S to make it easy. S company. Are they buying the net asset of S company or A is buying, so this, are they buying the net assets of the S or is A buying B, S with the word, giving them the word, the common stock here. So there's two ways. A can buy the word asset of the S. It can buy the net asset. What is net asset? Who can define net asset for me? What is net asset? Anyone? What do you mean by net asset? If we say net asset, what does it mean?
The
What is the
assets
net?
and liabilities.
Very good. It means that what? The asset minus the liabilities. That's a net asset. So is the company buying the net asset of the S company? Now, the next is that what is A giving up is very important. What is A giving up? What A is giving up is called consideration. Consideration here. What A is giving up, the consideration. Now, consideration is what you are giving up in order to acquire the business. In order to what? To get the business. Are you giving up? There's three things you can give up, or there's a three consideration. You can give cash to get a net asset of the company or the common stock of the company. So A can decide, you know what, I want to buy this company and give them cash. Or A can say, you know what, I'll give you debt. We know what is debt: note payable, account payable, that's the debt. Or he say, you know what, I'll give you stock. So A can give, whether buying the common stock or the net asset of the company, A can give them consideration of cash or consideration of debt or consideration of stock or all the above. It can give them all the above, meaning that it can pay part of the cost cash. It can also pay part of them through the debt. It can also pay part of them through the stock. So consideration simply means that what are you giving up in order to get a company? What you are giving up in order to get the company is known as the word consideration. Whether you are buying the net asset of the company or the common stock of the company, you can give either three of them: cash, debt, or equity stock, or you can choose to give them only one. Any questions so far about the consideration? Any questions? Any? In my class, that's what they will tell you. So, okay. So remember that. Now, asset acquisition. If the company is buying the company through asset, remember what you talk about. You can buy what you are giving, what you are getting, either the asset or the common stock. If they are buying the asset in an asset acquisition, firm must acquire 100% of the net asset of the other firm. It simply means if the company decided that we are getting S company, but we want to get S company through the asset acquisition, you have to purchase the 100%. You cannot own the company less. You have to get 100% of the ownership. Purchase the 100% of the company asset. You have to be able to purchase the 100% of the company assets. If you are using the stock acquisition in order to get the company, you need only 50%. You need only 50%. If you guys remember, we are going to do this in one of the class. You remember the levels of the ownership. If you have less than 20%, if you have less than between 20 and between 20 and 50%, if you have 20%, less than 20%, you are not controlling the company. You are just buying the company because you need the extra money through the dividend and also through the dividend. If you have more than the 20% but less than 50%, which means that we are going to learn, I think chapter 3 or so, you are going to get two things from the company: the net income, your portion, your share of their net income, and also your share of the dividend. If you have more than 50%, it means that gradually you want to get this company, but you don't want to take it hostile. You want to buy shares. So once you own more than shares, 100%, then we have to consolidate the account because you have more than the 50% of the company. The next important thing is the statutory merger. You can through the asset. If you want to merge the company together through the acquisition of the assets, this means that one company will die. I'm coming again. One company will cease to exist. So, for example, here, let's assume that A company want to buy B company. Now, at the end of the day, only A company will survive. B company will die. So only the A company is going to survive. So, for example, if A company acquire B company in a statutory merger, the business or combination is often expressed as A plus B equal to A, which means that B is gone. We don't have the B company. B doesn't exist. B will not survive. Only the parent company will survive. So if you read here, it tells you the acquiring company survived, whereas the acquired company cannot survive. It's gone. Acquiring company is gone. So what is the journal entry of the of A is going to record on the record? A is going to debit the asset of the B company, which is going to cease to exist. Is going to credit the liability of the B company, and it's going to credit the consideration. What is consideration? Who can tell me? What is it? Consideration here? Consideration can be what? The consideration that A is giving up can be what?
Cash, stock,
Very good. Can be cash.
or debt.
Very good. Can be stock or can be debt. It's very important because throughout you're going to hear the word consideration. What is A giving up to get the B companies that A can give cash, A can give stock, A can give the debt. Don't forget that. You have to let that stick.
But how we get our liabilities?
The liability of the B, right, is going to be the liability of the B. For example, let's make assumption that B, right? Let's assume that B already, remember B is a company by itself. So let's assume it that B already has the following. B has maybe cash. B has account receivable. B has a merchandise inventory. B has an account payable. This is the liability. So when we buy, we are going to debit the what? All the assets of the what? The B, which can include the inventory, cash. It can also, normally, they are not going to sell you their cash because it's already cash. So normally it's going to include the account receivable, merchandise inventory, maybe building, land, equipment. All these are the what? The asset of the B. Because you are buying, I'm coming back again. Because you are very good, somebody mentioned prepaid, very good, also included. And because you are buying the what? The company, you are assuming the liability of the company. Does that make sense now? You are assuming the liability of the company. That's why we have to debit the what? The assets of the company and credit the what? The liability, so that we can get the what? The net assets of the company. We can get the what? The net asset. Remember the beginning, I asked what's the net asset, and somebody said it's an asset minus the liability. So by debiting the assets and crediting the what? The liabilities, you are going to arrive at the what? The net asset. Then how much are you giving out? The consideration here. And that is why something called the goodwill will come in, which we'll get into it very soon. Goodwill will come in. If the company pay more than the net asset of the company, it means that there's a goodwill. There's a goodwill. Have I answered the question, please?
Yes, it is.
Okay, thank you. So the company, A company, B will cease to exist. But if they are buying it and what? Statutory consolidation, mean that they are going to consolidate two statements together, then both A and B will be closed to form a new company known as the word C. So when a new corporation is formed to acquire the two or more other corporations through exchange of voting stock, the acquired corporation cease to exist as a separate legal entity. For example, if C company is formed to consolidate the A and B, A company will no longer exist. B company will no longer exist, but C company will be created. So we are going to do the same thing that we did when we are here. We are going to debit the word, all the assets of the word, the A and B, all the liabilities of the A and B will be credited, and what are we giving up? Credit what we are giving up. Credit the word, the consideration, or the amount, or the stock, or this thing that we are what we are giving up. So let's this one supposed to be here. Then this one. Good. So they can also remember there's two ways. They can either buy the net asset or the stocks, the common stock. So if they occur when one corporation pay each cash or issue stock for or debt for all of the what part of the voting stock of another company, and the acquired company remain intact. Here, the company that you are buying will stay, because you are buying it through the stock acquisition, not the asset acquisition. So A will still exist, B will still exist. Then we prepare the consolidated account for the what? For the two companies. So A will prepare their financial statement, B will prepare the financial statement. Then we combine the two together. We combine the two business work together to create one separate entity known as the what? The consolidated what? Account. So company, when the journal entry, when you acquire the company, we are going to debit our investment in the B company. Now, investment is how much you are investing in the company. Then we are going to carry the consideration. In that case, we have to prepare something known as the working paper, because we have to prepare the consolidated account. Whenever the business have to prepare the consolidated account, they have to first do something known as the working paper. The working paper is where we eliminate intercompany transactions. We are going to eliminate the intercompany transaction. Each of the intercompany transaction will be what? Will be eliminated. We are going to what? Eliminate them. Now, possible advantage of the stock acquisition is that it lower the total cost. Imagine that you want to buy a company and the board of directors said, no, we are not going to give it to you. Then you have to go to the shareholders and give them more money. If you decided to get your way out, you can get it through the buying of the stock. Why? Because the stock is sold in the New York Stock Exchange. The company can just go buy more stocks, then they can have a control of the company. Because if they own more than 50%, they have the control. So that's one advantage. Two, direct formal negotiation may be avoided. I don't want to have any conversation and then the board of directors will say, oh, yes, oh, no. No, they don't want that. You can just go to stock market, buy the shares right away. You become the owner, majority owner of the business. Then you can acquire the company. So this is this is the same as what I've listed, acquired asset and often liabilities. The types of what I just explained. If we are acquiring of more than 50% of the voting right, that means that you get a control of the company. You get a control of the company. Okay, now let's talk about the other concept of consolidated financial statement. We have parent company concept and the economic entity concept. The parent company concept is to provide information relevant to the controlling stockholders' account. The non-control interest is presented as a liability. So a simple mean that they separate. We want to separate our own. That's the company one. The parent company want to separate that this is how much we own in the company in terms of the stockholders' equity session. And then they are going to treat the non-controlling, which I've already mentioned already. It used to be called minority interest. We are going to report it as a liability, not as a part of the equity. But when it comes to economic entity concept, the non-controlling is part of the component of the stockholders' equity. Is treated separate, but it's a component before it comes before the stockholders' equity or the parent equity. Now, this is what I want you to the goodwill. Before I go to the goodwill, let's see I want to see if we can do some of the class exercise. Let me see before I can. No, let's finish the goodwill. I think let's finish the goodwill here. Now, what is goodwill is very important, and how to determine the goodwill. Now, the term goodwill refers to the intangible asset that come into play when a company is planning to acquire another company and is willing to pay more money. Coming again. Goodwill always come to play when one company is trying to buy another company, but they are willing to pay more than the value of the company. It means that there's a goodwill. And as a matter of fact, companies always pay more than the value of the company to get it, because they look at the future of the company before they will even decide to buy the company. So amount that is paid is higher than the fair value of the net asset of the company. Then we say, yes, there is a goodwill because you are paying significant amount. You are paying more than the value. The value means that the market value, the fair value of the net asset. You are paying more than the net value of the asset. Simply means that you are ready to spend money, to pay more to get the net asset of the company. So, for example, here, if you look at it here, now, goodwill can be seen as a difference between the purchase price and the fair value of the asset identifiable assets and the liabilities. So if you pay extra money to get a company, we said, good for you. You are paying extra money. So there are 6 steps that you have to use to determine the goodwill. There are 6 steps you have to use to determine the goodwill. Step number 1, identify the normal rates of return for a similar companies. Identify the rate of return for a similar company. What does it mean? It simply means that, let's take one company. Let's assume that you want to buy Best Buy. You want to buy Best Buy. Now, the other competitors of the Best Buy can be Target. It can be PC Richard. So the question is, in a normal rate of return in the market, how much is the rate of return for the similar companies in the market? How much is the similar company in the same industry? How much is the rate of return of the company? You need to know the rate of return. It will be given to you. You don't have to figure it out. It will be given to you. The second thing that you have to know, step number 2. Oh, somebody question. Okay, let's see. Oh, yeah. I know. Yeah, Facebook. Yeah, you're right. Facebook border is, yeah, you're right. And that's a business combination. That's what we mean by the business combination. Now, the next one is to be able to, we are looking at step number 2. Apply the rate of return in the identified in step 1 to the level of identifiable net asset of the company that you are targeting or you want to buy. In other words, take the rate of return, subtract your liability from your asset, and find the amount of money that is the normal earning for the similar company. The normal earning of the similar company. Step number 3, estimate the expected future return. This is very important. The company that you are targeting, estimate how much returns that you are going to get if you buy this company. How much are you going to get if you decided to buy this company? Estimate that amount of the return that you are going to receive if you decided to buy the company. Now, one of the things you have to know that exclude any non-reoccurring, like salaries, the losses, extraordinary item, gain and losses, discontinue. Don't let it discontinue. Forget about that one. Don't include it. Step number 4, subtract the step 1 and step 2 from step 3. Subtract the step 2 from step 3 to get what is known as the excess earning. It means that's how much extra money you are going to get when you buy the company. If, I'm coming again, if step 2 is more than the step 3, stop right there. It simply means that there's no goodwill. You are gaining from this deal. You are gaining from this deal. So we call it business gain. So stop right there. There's no goodwill. You have to stop. Don't go further to calculate anything. Stop right there. But if step 3 is more than step 2, it means that there's a goodwill. So compute estimated goodwill from excess earning. If the excess earning are expected to be last indefinitely. This is very important. If in your idea or in your estimate, you know that the goodwill or excess money that you are receiving is going to be forever. It's going to be forever. Then divide your excess earning divided by the excess earning. Divide it, and that will tell you how much your goodwill is, how much extra money you are paying. But if the excess earning is not indefinite, meaning that it has a defined years, you are estimated maybe 2 years, 3 years, 5 years, then you cannot use we have to use the present value ordinary annuity. That's the table I showed you the last time on our first class. I show you on this thing that in the exercise in the homework, you have to use that table to determine how much is the ordinary annuity if the excess earning as a limit. As a limited this thing, then you have to be able to use that. Step number 3, to know how much you are paying, add the step 5, your goodwill that you receive to the net identifiable assets of the company that you are buying to arrive at how much you are willing to offer, how much amount you are willing to offer to get the company, to get the company. Now, that is the end of the lecture notes. So any questions? Any questions? Any? Before I continue, we are going to solve some of the class exercise, which is the similar questions in the class, in the homework. Any questions? Any? Before?
Professor,
Yes, please.
please, a colleague asked about the liability, and you stated the receivables and stuff. Is the liability always given?
Oh yeah, they are going to give you the liability. Always, they are going to give all the information. They will give it to you if they want you to determine the goodwill or to calculate the
sure.
goodwill. They are always going to give it to you.
Okay, thank you.
You're welcome. They are always going to give it to you.
I have a question.
Yes, please.
Are we going to be doing any exercises on these 6 steps?
Of course, that's what I'm going to do now.
Okay, thank you.
That's our next step. So let's do the class exercise here, which is the similar one do you guys see my screen, please? Okay, so we are going to do on chapter 1, we have only 3 questions we have to answer in the homework. Now, if you look at the first one here, say estimate the goodwill and the potential offering price. How much the goodwill of buying this company? And also, how much is the price are you willing to pay? So the Plantation Home Company is considering acquisition of the Condominium Incorporated. So they decided to buy, they are wondering, should we buy this company or we shouldn't buy this company? That's what they are estimated to do. That's their plan. They are trying to do here. So what happened? They were willing to, let me see if I can get everything here. So this is what is happening here. They were willing to buy this company here. Plantation Home made the following condominium has identifiable net assets. So they find out that this company have the identifiable net asset, identifiable asset of the 7.8 million. At the same time, they also have they have the liability. They also have the liabilities of they are owing 4.4 million. The asset include the office equipment with the fair value approximately the book value, and the land with the fair value of the 75%. The remaining life of the asset deemed to be approximately equal to those used by the company. So what they are trying to say is that when it comes to the equipment, here, I'm trying to see. Give me one. I want everything to be on the same page. So let me see if I can do this. Okay, good. So here the value, the asset include office equipment, both the fair value approximately the book value, burden with the fair value of 30% higher. Let's stop right there. What does it mean? It simply means that they are telling you that the company already have this asset already. They have the burden, which every year the depreciation is 480,000 every year depreciation. The company also have the equipment where they have to depreciate it. Every year the depreciation is 25%. The company also has incurred the extraordinary loss on the 2016. Now they have the sales commission. We don't care about this one. This is a reoccurring expenses. If you buy the company, we're still going to pay them the sales commission. So we don't care about that. But this word we care about here. They are saying that in the market, the fair value of the building is higher. So every year, the company, if you buy the company, you have to extract or depreciate extra 30% of the burden. So in addition to the 480, which every year you are going to depreciate, you have to depreciate extra 30% here, extra 30% as depreciation if you buy the company. When it comes to the equipment, they say, no, the equipment, the value is the same. So you are not going to, every year is only the 25,000 that you are going to do. You are not going to extend any extra money. And when it comes to land, this company have a land, and the value of the land has gone up by the what? 75%. We don't care about the land. Why? Because we don't depreciate land. You all know when you started your accounting, you were told in the beginning of the introduction to financial accounting that we do not depreciate what? Land. So the land increase is good news for us, but we are not going to depreciate the what? The land. Now, let's go ahead. They have also assumed that B, condominium incorporated pre-tax, the tax before the income tax is the what? $600 for 2027, $750 for 2028, and the what? $475 of 2029, respectively. Plantation Home believe that the average of this earning represent a fair estimate of their annual earnings that they are estimated to get for the word indefinite. B, however, it may need to consider adjusting the following items for the pre-tax. So A, now if you look at A said, assuming that the plantation home fee that it must earn 25% return on investment and that the goodwill is determined. The goodwill is determined by capitalizing excess earning based on the what? That this assumption, calculate your what? Your steps, the 6 steps. Normally, step 1 and 2 is always together. Step 1 and 2, if you guys remember, I can go back and look at the step 1. I'm going to share it back again. Step 1 said, identify the normal rate of return. And also determine the what? Multiply the what? The rate of return by the what? The net identifiable net asset. So everything is given to you right here. The rate of return here was given here as a 15%. This right here. The normal rate of return is a 15%. Now, so here we are going to do the two together. You can do the two together here. Now, this is equals to those with the calculator, you can do it. I'm also doing it here. Now, first, we have to determine that this is equals to, I'm going to take the what? The net the asset of the company, 750,000. So 707.5 here. Less the what? The liability, 4.4 million. This is the what? The net asset, but this is not your answer. This is the net asset. So I can do it here if you want. I can do this one here. This is 7.4. Is it 7.5? Not 4. Minus the liabilities, 4.4 million times 0.15, 15%. So those with the calculator, how much do we have? Let me take this one here. How much is the normal here? How much the normal earning for similar companies? Anyone? I have this
Or
amount.
no.
I don't know if I'm right. It's good. This
Three.
one.
Yeah.
But remember, you have to deduct this first before you multiply by the 15%. Any question before I move on? Any? I
No.
told you in my class, I always take my time. So any questions?
No.
Okay. Step number 2 said, okay, determine the what? The every year, how much is the earnings that you think you are going to what to make? So we start by the pre-income on 2027. We start the pre-income, this one. This one was given to us. This, you don't need this one now. So as a matter of fact, let me underline it. You don't need this number here now. This will be your last step to do your, when you want to do the comparison. So here, we were told here the net income for year 1 is a what? 2017, it's a 600,000. Okay. Now you are going to here, you are going to subtract the extra depreciation you have to take every year, extra depreciation on burden. Come on, give me 1 second. I hope it's going to allow me. So the extra depreciation on the burden, you were told that is 30%. So 480,000 times 0.30. Where do you get a 480 from? Is right here. 480 every year. We have to have another 30% of the depreciation for the burden. Is right here. So how much do we have here? Those with the calculator.
144.
44.
144. Thank you. 144. 144. Okay. So subtract. So this is our expected earnings that we are going to earn. How much the difference here? How much the difference here? So this is adjusted earnings for 2017.
56.
456. 456 like this, right? It's
Yeah.
good. Okay. Then we come to the pre-tax on the pre-income tax on the 2017, 18. If you look at it, was given as what? 750,000. So pre-750,000. We're going to subtract the same thing. So let's this amount, let's put this one here, which is going to be the same 144. So how much is the
606,000.
606?
Yes.
Okay, thank you. Then we come to 2019. So this adjusted earnings, you can bring it here and change this one to 2018. 2019, we have okay. 2019, we had the this thing of 475. 1 second. I want this to be uniform. Okay, now we have the word. Let's add. We are going to add the extraordinary loss that was taken. This is something that doesn't really happen often. So we are going to add it back. Which is 150,000. Then we are going to subtract the depreciation. Which is 144. So those with the calculator, how much is our adjusted earnings?
481,000.
481,000. Thank you. 481,000 here. Now we want to know, the next step is we want to know how much the target earning for the 3 years. So we are going to add all the three numbers here. So how much the earning for the 3 years? How much is it going to be the earning for the 3 years? Those with the calculator, please do for me.
$1.543.
So 1,543, right?
Yeah.
Okay. I'm going to stop right here. We are going to continue. I told you by 8:30 we're done. So I'm going to continue this and finish the chapter 1 on God willing on Monday. Any questions so far? I told you our attendance is, I know how to take it attendance, so I don't need to take attendance in class. So any questions, please?
No,
Any?
thank you, Professor. Have a good night, okay?
Good night. See you guys on Monday.
See you on Monday.
Thank you.
You're
Thank you,
welcome.
Professor. Good night.